Welcome to the deep dive. Today we're embarking on a really fascinating journey, almost like an archaeological dig.
Yeah, into the foundations of a company many people now really admire for its long-term thinking and its unique approach.
Exactly. We're setting the clock back quite a bit, all the way to 1986, a pivotal year.
That's right. Because for Markel Corporation, 1986 wasn't just, another year on the calendar. It was their big public debut.
Ah, the IPO.
The IPO, yeah. And our mission today in this deep dive is to really unpack their very first shareholder letter, the one right after they went public in December 86.
So not just a financial report then.
No, not at all. Think of it more like a strategic manifesto, kind of laying out the vision that, would guide Markel for decades to come.
And that's our goal, isn't it? To use this foundational document as our map to understand their early philosophy, their financial health right at the start, and the strategic path they plan to follow.
Right. So you, the listener, should get a really clear picture of Markel's early days, and I think some timeless lessons, too.
Lessons that go beyond just insurance, I bet.
Absolutely. Far beyond. Our main source is, of course, the 1986 shareholder letter itself, direct from the leadership.
Can't get more primary than that.
Exactly. And we've also got some discussion points lined up to make sure we hit all the crucial bits and, really get the why behind their early moves. So where should we start digging?
Okay, let's start with that big moment. Markel hitting the public stage. The IPO in December 86. This first letter. It feels like more than just paperwork. It's a declaration, right?
It really is. It's their first public statement about who they are and maybe more importantly, who they want to be. And the people signing it, that tells you a lot.
Who was signing it back then?
You had Alan I. Kirshner as president and chairman, Anthony F. Markel and Stephen A. Markel as executive VPs. But what's really interesting is they specifically call out the significant contributions of the older generation, Milton and Stanley Markel, even though they'd moved into advisory roles.
So acknowledging that history, that continuity.
Precisely. It signals this deep respect for institutional knowledge, a continuity of vision. You don't always see that during the frenzy of an IPO.
No, you don't. That long-term view seems baked in early. But it wasn't just the Markel family, was it? The board members mentioned. They seem quite significant, too.
Oh, absolutely crucial. I mean, this is a fantastic detail for anyone studying how great companies are built. The letter mentions V. Prem Watsa.
Prem Watsa of Fairfax Financial.
The very same. Back then, he was identified as the principal of a prominent Toronto investment firm and chairman of Markel Financial Holdings in Canada. His presence wasn't just window dressing.
Right. What did it signal?
It immediately injected this disciplined, value-oriented investment philosophy right at the top. Watsa was already known for that patient, long-term, almost Berkshire-like approach to capital.
Wow, okay. And there was someone else mentioned, too.
Yes, Stuart M. Kazin, who was CEO of Thalhammer Brothers, a big department store chain, so you had deep operational and retail know-how there, too.
So investment discipline and operational experience.
Exactly. It shows this really deliberate focus on strong governance and bringing in seasoned outside expertise right from the get-go. Pretty sophisticated for a newly public company, actually.
It really sounds like they were setting the stage very intentionally. Okay, so what about the world they stepped into? The market landscape in '86? The letter calls the insurance market tight. What did that mean?
Yeah, tight back then meant things were tricky. Price levels were going up, and some kinds of insurance were just plain hard to get. Less competition, but maybe not for good reasons.
So a tough environment for many insurers.
For many, yes. But Markel frames it as an opportunity. They actually attribute their excellent results to being able to obtain increased prices with less competition.
Ah, so the tightness actually played to their strength.
It seems so. It suggests that because they were specialists, they could command those higher prices when others maybe couldn't or wouldn't write the business. They were thriving, not just surviving.
And the letter also mentions signs of recovery in the industry.
It does. It suggests they navigated the worst of it and were sort of poised for things to get better. A challenging backdrop, but one they were clearly handling well.
Okay, so that sets the scene. Now, what about their core philosophy, their strategy? What guiding principles did they lay out in this first letter?
Well, they're very clear. They emphasize being an outstanding underwriting organization, and that's not just buzzwords for them.
What does outstanding underwriting mean in this context?
It means a relentless focus on selecting the right risks and pricing them properly. So much so that they aim to make a profit from the actual insurance side of the business year in, year out.
Before even considering investment returns.
Exactly. That underwriting profit is the gold standard for a great insurer, and they put it front and center from day one. They weren't just selling policies, they were focused on customer needs and solving customer problems.
Within specific areas, right? That niche focus comes up.
Oh, yeah, that's maybe the cornerstone. Their strategy was explicitly to specialize in unique market niches where their expertise enables them to be the very best.
That sounds powerful. How unusual was that niche approach back in '86?
I'd say pretty countercultural. A lot of insurers then were chasing scale, trying to be big everywhere. Markel said, no, we'll focus.
What does that focus give them?
It means deliberately avoiding the commodity stuff where you can't really add value or get paid for your expertise. It's about being the absolute master of specific, maybe overlooked areas. Over time, that builds a huge competitive advantage, a real moat.
But sticking to that must require discipline, especially today when there's so many distractions.
Incredible discipline. The hardest thing is often saying no to business that looks tempting but isn't really in your sweet spot. That's tough.
That focus is a great lesson. Now, they also mentioned people, didn't they? Something about the work atmosphere.
They did. They stated a desire to maintain an atmosphere conducive to personal growth and achievement for employees. That's quite forward-thinking for '86.
How does that connect to the bigger picture, to the strategy?
Well, if you're going deep into specialized, complex niches, you absolutely need smart, skilled people who are constantly learning. So creating that kind of atmosphere isn't just nice, it directly feeds their ability to be the experts and maintain that underwriting discipline.
It's like investing in the engine of the business.
Exactly. It suggests a culture where, integrity and accountability aren't just words on a poster, but are genuinely fostered by empowering people.
Makes sense. So specialized niches, great underwriting, investing in people.
Mm-hmm.
What about growth? Did they talk about how they plan to expand?
Yep, very clearly. They outlined a strategy of specialization and diversification.
Sounds a bit contradictory.
Not the way they framed it. It meant diversifying within their specialized approach. They expected to continue growth and development of new product areas, so organic growth by adding related niches.
Okay.
And they were also ready to take advantage of acquisition opportunities, so a mix of building and buying from the start.
But presumably buying things that fit their niche model?
That's the implication, absolutely. Finding complementary businesses where their expertise and discipline could add value.
And they put a number on their ambition, didn't they? Something about returns.
They absolutely did. And this is really striking for you as a listener thinking about long-term value. Their stated long-range goal was to earn an annual return on equity in excess of 20%.
20% ROE.
Yeah.
And their first letter as a public company.
20%, yes. That's incredibly audacious. Most newly public firms would be talking about revenue growth, market share.
But they focused on profitability, on return on capital.
Precisely. It wasn't just a hope. It was like a declaration of their capital allocation philosophy. They were basically saying, we will not grow for growth's sake if it means compromising this level of return.
That's a powerful filter for decision-making.
It forces discipline. It signals that they understood compounding, that every dollar they kept needed to work really hard. Patient, disciplined investing baked right in.
20%. That really is a statement. Okay, so they set the vision, the strategy, the goal. How did they actually do in 1986? Let's peek at those financials.
Right. The proof is in the pudding, as they say. And the numbers were, well, pretty impressive, especially given that tight market.
Lay them on us.
Okay, total operating revenues hit $33.3 million. That was up 45% from 1985.
45%. Wow.
Yeah. Income before realized investment gains so close to that core operating profit jumped 89% to $4.7 million.
89%.
And net income reached $5.0 million, up 60%. Per share, that was $1.61 compared to just 32 cents the year before.
Those are huge jumps. That really backs up the idea they were thriving, not just surviving, in that tough market.
It really does. It suggests their niche strategy and pricing power were working almost immediately.
Now, you mentioned a detail about a real estate gain in there.
Yes, important to note for clarity, the letter mentions a gain of 17 cents per share from selling some real estate was included in those 1986 numbers. So you adjust for that, but the underlying growth is still very strong.
Got it. Okay, now there was a slightly confusing bit about claims, wasn't there? The letter said something about demonstrating results, but also reporting a net loss. How does that work?
Yes. This is a good example of needing to read carefully and understand how companies report things. They said their core underwriting operations had excellent results.
Right.
But their separate claims administration operation, which you could think of maybe as an internal cost center handling the claims process, actually reported a net loss for the year.
So it wasn't the insurance results themselves, but the cost of managing the claims.
Exactly. It wasn't a flaw in their core strategy, but maybe an operational inefficiency they spotted in how they were handling claims processing, and they were transparent about it.
And did they say what they were doing about it?
They did. Right after mentioning the loss, they point out they hired Edmund Kranghorn as president of that claims division. So, identify problem, report it, take action. Shows proactive management.
Okay, that makes sense. Transparency, even about the bumps in the road. So, stepping back from the details, what are the big, timeless principles we can pull from this 1986 snapshot?
Well, for me, the biggest one is that commitment to patience and compounding. That 20% ROE goal isn't just a target, it's a whole philosophy.
A philosophy of building wealth slowly but surely.
Exactly. Through consistently high returns on the money you keep in the business, not by chasing fads, it demands that long-term mindset from management.
And the focus on people, on that atmosphere conducive to personal growth. That seems like another cornerstone.
Absolutely. It shows they understood early on that culture isn't just fluff, it's vital, especially if you rely on specialized expertise.
How does it foster things like integrity and accountability, do you think?
Well, if people feel invested in, if they feel like they're growing and their contribution matters, they're much more likely to, take ownership, act ethically, and hold themselves and others accountable. It creates a positive feedback loop that strengthens the whole organization.
It all sounds, well, familiar, doesn't it?
Yeah.
People often compare Markel to other great investors or companies. Does this 1986 letter show early signs of that? Maybe a Buffett-esque approach?
Oh, definitely. The parallels are quite striking, even back then. That intense focus on underwriting discipline, making money from insurance first, is classic Buffett.
Like generating float cheaply.
Precisely. And then the focus on unique market niches. That's all about finding businesses with competitive advantages, or moats, sticking to what you understand.
And the 20% ROE goal.
Pure capital allocation discipline, thinking like an owner, demanding a high return on every dollar invested back into the business. It's very much in that same intelligent investing playbook. Understand the game, excel within your circle of competence, let compounding work.
So bringing this home for everyone listening, how do these ideas from Markel way back in 1986 apply today? To investing, or maybe even just to building anything worthwhile?
I think they're incredibly relevant, maybe more relevant than ever in our, often short-term focused world.
Hope so.
Well, the idea of deep specialization, of really mastering a niche, that's powerful in any field. The importance of rigorous risk management, which is what underwriting really is, applies everywhere. Investing in your people and having that clear, ambitious, long-term vision.
Instead of just chasing the next quarter's result.
Exactly. These are the bedrock principles for building something robust, something that lasts. It's not just for investors. It's a blueprint for sustainable success, period.
What a fantastic look back. So we've gone deep into Markel's 1986 debut. We've uncovered that early focus on niche expertise, hardcore underwriting discipline, developing their people, and that really bold long-term goal for returns.
It's quite something to see it all laid out so clearly, so early on, and to know how consistently they've stuck to it.
It really is. Okay, time for our final provocative thought for you, the listener.
Right.
Imagine you got that letter in 1986. You're a potential shareholder. This relatively unknown company comes out talking about a 20% plus return on equity goal. What's your gut feeling? Do you buy in?
That's a great question. Takes conviction.
It does. And reflecting on everything we've discussed today, what's the one idea from Markel's early philosophy? Maybe the niche focus, the underwriting, that ROE target that you think anyone trying to build something lasting, investor or otherwise, should really take to heart? And how could applying that change your approach today?
That's something to chew on. It really makes you think about the power of clarity, discipline, and having that long-term horizon, doesn't it?
It certainly does. We hope this deep dive gave you some valuable perspective and maybe some inspiration. Join us next time on The Deep Dive.